Okay, so it is kind of wild when a company basically prints money for a quarter, hoards cash, and then the market responds by aggressively selling off their stock in the dark. You're listening to Earnings Unscripted. It is February 24th, 2026, and today we are unpacking First Solar, ticker FSLR, and their fourth quarter 2025 results. And Miro, they are building these massive solar panel components, but it seems like building a predictable earnings narrative is proving to be a lot harder. What did they actually report?
Well, if you just look at the raw closing numbers, it was a fantastic quarter. They posted net sales of $1.68 billion, up about 5.5% sequentially. Diluted EPS came in at $4.84, which is a really solid bump from $4.24 in Q3. And their operating margin hit 32.5%.
Wait, quick thing just to jump in before we go deeper. As always, this is not financial advice, just our personal opinions on the data.
Exactly. So with those strong margins and operating expenses dropping off a cliff because their new Louisiana factory startup costs basically vanished, they ended the year adding almost $800 million in net cash. They are sitting on $2.4 billion now. The business of making thin-film solar modules is clearly working right now.
Right, which is objectively great, but then the closing bell rings and the stock just violently gaps down. I think it fell, almost 13% down to the low 210s in after hours? Why the sudden panic if the balance sheet is basically a fortress?
Because the market price is the future. And their 2026 visibility just went completely dark. The big shocker was that management is just flat out refusing to give an EPS target for next year.
Just no guidance at all?
They're shifting entirely to adjusted EBITDA. They cited this incoming OECD global minimum tax framework, Pillar 2. The CFO basically said it makes their tax liability so complicated and noisy that an EPS number would be essentially meaningless, which, equity investors hate uncertainty.
I would too if I'm trying to model earnings and the company tells me, actually, the international tax math is too hard this year. I'm going to rethink my position. But is it just an accounting headache, or is there a real operational issue hiding in there?
It is definitely both. The other massive hook here, and this is wild, is how expensive reshoring their supply chain is getting. They're choosing to keep their Southeast Asian factories in Malaysia and Vietnam running at extremely low utilization rates, around 20%. They are literally projecting to eat $115 to $155 million in underutilization penalties next year, just to maintain option value.
Hold on, so they are intentionally paying well over $100 million to not produce solar panels?
Yes, because the reciprocal tariffs it's the specific U.S. import tariffs on Asian components, they are so severe right now that it is mathematically cheaper to leave those foreign machines mostly idle. They're just absorbing the overhead while they're frantically trying to scale up their domestic finishing factories.
Geez, that is the literal definition of a rock and hard place. Okay, there is a ton to unpack there, from the tax black box to this whole tariff blockade strategy. Let's really get into the details on this.
Well, if we are looking at the details, I think the most fascinating part isn't the factories they are turning off. It is the contracts they are tearing up.
Wait, tearing up? I thought their backlog was supposed to be the bulletproof part of the thesis.
Right, it is. They still have about 50 gigawatts in contracted backlog, but they actually debooked 8.3 gigawatts for 2025.
Hold on, 8 gigawatts? That sounds, massive.
It is huge, but the context is wild. They didn't lose the business to a competitor. They essentially fired the customers for breach of contract, mostly tied to macro shifts with oil and gas developers scaling back. And because they enforced their contracts so aggressively, First Solar booked a one-time $61 million revenue boost just on termination penalties alone.
So wait, they literally made over $60 million by their customers failing to follow through?
Yes, exactly. It is It is a fantastic structural defense mechanism.
I mean, that is, wow. It's like they're generating revenue just by holding the line with their legal team.
Actually, speaking of lawyers, the enforcement contract is just defense level 1. Defense level 2 is what they are doing at the border.
Oh, right. The ITC petition? The TopCon patent issue?
Precisely. They are basically weaponizing their intellectual property. First Solar filed a new petition with the U.S. International Trade Commission targeting 10 foreign competitors. The CEO was very explicit on the call. He said, and I quote, "If our case is successful, the ITC may issue a general exclusion order preventing importation of infringing TopCon products made by foreign entities."
Okay, so translating that out of legal speak, they are just suing for damages. They want the government to physically ban competing solar panels from even crossing the U.S. border.
Bingo. A total border exclusion, which, if you think about it, makes their whole structural play make perfect sense. They're paying over $100 million to keep Asian factories idle to dodge inbound tariffs, right?
Yeah.
But simultaneously, they are trying to lock everyone else out of the U.S. market entirely through IP law. It's a scorched earth strategy. And it actually ties perfectly back to that one big, beautiful bill legislation we keep hearing about.
Right. The new bill that is kind of upending all the historical green subsidies. How does that factor into this border ban idea?
Well, that bill severely constrains rivals from getting U.S. tax credits using these foreign entities of concern checks, which mostly blocks China-tied groups. But First Solar's own profitability is anchored to the Section 45X manufacturing credits, so they are aggressively walling off the U.S. market to protect their 45X margins. They just, monetize those credits for incredible liquidity.
Can I jump in? So if I have this right, the U.S. market is their golden goose because of those domestic 45X subsidies. They are ditching international volume, firing customers who get shaky, and suing to build a literal IP moat at the ports? That is not just a solar manufacturing company. That is like a fortress built out of tax credits and lawyers.
A very profitable fortress, yes. But it also means their growth is fundamentally bound to the whims of D.C. policymakers and trade courts, not just technological innovation, which is a huge vulnerability.
Which makes me think of that Oxford PV deal they just announced.
Right, the perovskite patents.
Yeah, securing that non-exclusive license for perovskite tech feels like a bit of an insurance policy on the actual science of it all, right? Trying to look beyond just their standard cadmium telluride setup.
Exactly. It shows they are not entirely blind to the engineering side. They know they eventually need a multi-junction or non-silicon future to stay ahead of the efficiency curve.
But still, it feels like right now, their most effective product isn't a physical solar panel. It is aggressive trade policy.
It certainly pays better than the panels do, sometimes.
Geez, so if their entire model right now revolves around defending this heavily fortified U.S. island, where does that actually leave their fundamental trajectory heading into the rest of the year?
Well, it leaves them completely dependent on executing a flawless domestic scale-up. Look, they entered 2026 with their U.S. production fully allocated. That is undeniably impressive, but they are entirely reliant on keeping that local machine running perfectly.
Hold on, but that is the massive risk, right? If you are eating over $100 million a year just to keep Asian factories idle, your local operations basically have to be perfect to justify it.
Exactly. And they might not be. The CEO actually called out a critical module glass bottleneck here in the U.S. right now. They're being forced to import raw glass, pay inbound materials tariffs on it just to build the panels locally. It is a very expensive friction to absorb.
Wow, so they are essentially importing inflation to satisfy domestic manufacturing requirements. That kind of changes the whole vibe of that 50% gross margin we saw this year.
It does, which is exactly why pivoting away from EPS guidance to focus solely on adjusted EBITDA makes the street so nervous. Blaming the Pillar 2 global tax complexity is, mathematically valid, but when you blur the bottom line during a huge structural transition, investors just assume the worst.
Right. Uncertainty is the only thing Wall Street consistently prices at a discount.
Precisely. But we have to give them credit where it is due. They are sitting on $2.4 billion in net cash. They survived the offshore panel wars. They have a massive 50-gigawatt backlog. And they are navigating a deeply protectionist environment exactly how legislation incentivizes them to. They are survivors.
Okay, fair point. So looking to next quarter, we basically just need to watch if that domestic glass supply actually holds up and maybe see how this whole EBITDA-only story plays out in real time.
And watch if any more energy developers try to breach their contracts, because First Solar's legal team is clearly their most profitable division right now.
Okay, yes, I think that is the perfect place to leave it. We will definitely be keeping an eye on those billable hours next quarter.
Yep, that about covers it.
All right, I think that is enough damage for one episode. So if you want these breakdowns to just show up automatically, go ahead and follow the show. Just a quick reminder, this is an AI-assisted project where we pull the filings and transcripts to summarize what actually mattered. And we would really love to hear your thoughts or ticker requests at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out with us, and we will catch you after the next bell.